Welcome back. Here we are, Chapter 9, video on the allowance method of accounting for bad debt expense. And this particular video is specifically going to be over estimating bad debt expense using the percent of receivables method. We're again going to do example, and we're going to use the kid company again for this example. And we're going to use the same basic data that we used on the previous video. So take a look here at the slide, and it says Kid Company has the following data as of December 31st, 2010, which again is the end of the accounting period. That's the only time under the allowance method, it's the only time that you will make an adjusting entry for bad debt expense is the last day of the accounting period. Total sales for the year are $825,000. The accounts receivable has a balance of $275,000. And the allowance for doubtful account has a $500 debit balance as of the last day of the accounting period. Bad debt is estimated to be 4% of total accounts receivable. What we need to do is calculate the estimated bad debt and make the proper adjusting entry. So looking at the next slide here, you can see down at the very bottom there that to do the calculation, again, very simple calculation. We just took the accounts receivable, $275,000, times our estimated percent, 4%, and we estimate that we will not be able to collect $11,000 of our accounts receivable. And you can also see I made a T account there of the allowance for doubtful accounts, and again it has a $500 debit balance. Well, the next thing we need to do is we need to make the proper journal entry. Now, I want to emphasize something. Here is where students get confused. Remember, under the percent of sales method, we made our calculations, we came up with the estimated amount of bad debt expense, and we simply made the journal entry for that amount, whatever that was. Well, when we use the percent of receivables method, it is slightly different. We do our estimate here, and we came up with 11,000 in this case. When it's the percentage of receivables method, we are saying we want the allowance for doubtful accounts to have an $11,000 credit balance. Whatever that estimate is, that's the balance we want to have in our allowance account. So currently, the allowance account has a $500 debit balance. So what do we need to do to give it a $11,000 credit balance? Well, we need to debit bad debt expense for $11,500 and credit the allowance account for $11,500. And as you can see from the next slide, that's what we do. Maybe you can or cannot see that next slide. Looks like you just we went into the abyss here. But what we've done is we've debited bad debt expense for $11,500, and there it is. There's our slide, isn't it? So you see right there where we've debited the bad debt expense for $11,500, and we credit the allowance for doubtful accounts. Our $11,500 kind of dropped. Sometimes they do funny things here when we're on the video. We know that $11,500 should actually be right up there as a credit, shouldn't it? But we can overlook that. You see the point here, and again, the most important thing to see is that we're forcing that allowance account to have that proper $11,000 balance. So here's our original $500 balance in the account, debit balance. Here is our posting of $11,500 because we credited the allowance for doubtful accounts for $11,500. And what does it do? It gives us that $11,000 credit balance that we desired based on our estimate. Now remember, under the percentage of sales method, we don't do it that way. Under the percentage of sales method, we just make our estimate and we make the journal entry. Oh, now I'm kind of out of blur there. There I am, I'm back. Under the percentage of sales method, we just simply make our estimate and make the journal entry for whatever that estimate is. Right? You understand that? As usual, if you have any questions, post to the discussion board and I will clarify further. And I hope you have a good day.